Well, good afternoon, ladies and gentlemen, and thank you for joining us here today for another OIC-sponsored webinar presentation. My name is Ken Keating, and I'm an Associate Principal at OCC Investor Education, as well as an Options Industry Council instructor. And I'll be giving today's presentation on understanding the option Greeks. Just to give you a quick background on myself, I was a professional floor trader for well over 25 years. I started out on the floor of the Pacific Coast Stock Exchange in the early 90s. I moved to Chicago, where I was also a floor market maker and a floor specialist. I ran off-floor prop desks as well as risk management desks. I traded for myself for many, many years as a sole proprietor, and I also worked for many years as a derivatives and equities analyst. So currently I work at the OCC, helping individuals and investors such as yourselves to better understand both the risks and the benefits of exchange-traded options. So speaking of the risks and benefits of exchange-traded options, we always have to mention the disclaimer. So options are a rather complex tool that needs to be studied and understood before trading in a live account. So anyone who's looking to trade options should read and understand the characteristics and risks of standardized options, which you can obtain by visiting us at theocc.com to download a digital copy, or you can always contact your broker as well. In order to simplify the computations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies discussed here today are strictly for illustrative and educational purposes. Okay, a little bit about the OIC. So who is the OIC? Well, the Options Industry Council, we are the education arm of our parent company, the Options Clearing Corporation, which is the world's largest equity derivatives clearinghouse for exchange-traded options in the United States. So we started out as a collective in 1992 to better help the public understand both the risks and benefits of exchange-traded options. We do that primarily through our website, optionseducation.org. There you'll find online courses, podcasts, videos, as well as webinars like the one you're listening to today. And we are able to do this free of charge. This is a free and unbiased options education service that we provide, and we can do this because we are fully funded by our parent company, the OCC. So the pride and joy of the OCC is or the OIC is our investor services desk, which can be reached at options@theocc.com with any and all of your options-related questions. Now, this is a free service that we offer as well. However, we are not licensed to give you guidance. We can't direct you on trades, but we can help you think about general strategy, theory, as well as breaking down any potential corporate actions and how they might impact your options positions, or just about any other question that you have related to options in general. All right, here's one of my favorite charts. This is the annual options volume from 1973 all the way to the present. So options started trading in 1973 on the Chicago Board of Options Exchange. They actually didn't start trading puts until 1977. But as you can see, the growth and trajectory of options has just been phenomenal. Right around the turn of the century, option volumes really started to pick up. We started to see more electronic trading, high-frequency trading. 2008, obviously, we had the financial crisis. 2011, we had the sovereign debt crisis. 2018 was a record year at that time for OCC, where we cleared and settled 5.2 billion contracts. But 2020 was a phenomenal year for the industry. Now, we cleared and settled 7.5 billion contracts in 2020. And while the industry was celebrating record volumes, the reasons behind those record volumes were certainly no reason to celebrate. Obviously, we were dealing with COVID back then. We still are today. We were dealing with an election. So there was plenty of volatility in the markets, but with volatility comes opportunity. And as you can see, there's plenty of investors flocking to the options market, not only to protect themselves, but also to position and speculate on the market going forward. All right, here is today's presentation outline. We are going to first talk about the Greeks. We're going to do an overview of the Greeks, and then we are going to examine each of the Greeks individually. So then we will look at delta. We will then talk about gamma. We will look at Theta or time decay. We will also look at Vega and implied volatility, and we will also examine Rho and interest rates. So this particular, this presentation today is actually going to take the full hour. Normally we reserve some time at the end for live Q&A. This is going to be a lot of material. So Q&A for this presentation is actually going to be conducted along the way. My colleagues Mark Benzaquin and Ed Modla are behind the scenes answering your questions in real time, so certainly make use of that feature. There's a Q&A box that you can enter your questions for the presentation right there. All right, so let's talk about the Greeks. These are the 5 Greeks. These are what are called the first order Greeks. There's delta, gamma, theta, vega, and rho. Now, there are such things as the second and third order Greeks. We're not actually going to talk about those. The second and third order Greeks actually takes the analysis to a lot more granular level, but these are the 5 main Greeks that you need to be concerned with. When I was trading over my career on the trading floor, these are the 5 Greeks that I dealt with. I never dealt with second and third order Greeks. Not to say that there's not value there, but these are the Greeks that you need to primarily be concerned with, these 5 right here. All right, so let's talk about the nature of the Greeks. What exactly are the Greeks? Well, the option Greeks measure the different factors that can affect the price of an options contract. So just like the dashboard in your car gives you feedback on the condition of your car. Say you're driving along and you look at your dashboard and you see you have a half a tank of gas, your tire pressure might be a little low, the engine's a little warm. It's giving you feedback on the condition of your car. Well, you can look at the Greeks as a dashboard to the condition of your options position. So by looking at the Greeks, it can give you an indication of your position and any potential risks that might be there, as well as how your option position might change given different changes to the input. So if you understand the Greeks, you can anticipate options pricing. So the Greeks are only meaningful during an option's lifetime. So what does that mean? Well, we all know that options have a finite life, whether they're weekly options or long-dated options like leaps. So at some point, the lifetime of an option ends. So at expiration, that option is either in the money or it's out of the money and it finishes without value. Those are the 2 outcomes. Now, the Greeks themselves can have an effect on other Greeks. So for instance, an option's theta or time decay may affect its delta. So as we get closer and closer to expiration, that time decay increases, which may affect its option's delta. And we'll get into all the individual Greeks themselves, but just know that the Greeks can affect each other. And a change in implied volatility can also affect the option's time decay as well as its delta. So the Greeks do affect each other. And the impact of the Greeks will also differ depending on which contract you're looking at, whether it's an in-the-money contract, an at-the-money contract, or an out-of-the-money contract, as well as both a near-term or far-term, an option that expires in a week, or an option that expires, say, in 2.5 years. Depending on the strike and the duration of the contract, the Greeks have a different effect. All right, so let's take a look at the first Greek. The first Greek we're going to look at today is delta. And delta is probably the most familiar of all the Greeks. It's the easiest, I think, of all the Greeks to understand. So each option has its own delta, and whether it's in the money, at the money, or out of the money. And the options delta is going to be different depending on whether the contract is in the money, at the money, or out of the money. Now, a delta is your option sensitivity to a 1-point move in the underlying stock price. So in other words, if the stock price goes up by $1 or down by $1, how is that going to affect my options position? So let's take, for example, a $100 stock. And we're going to look at a deep in the money call. So a $50 call with the stock trading 100. That's going to be a very deep in the money call. That option has $50 of intrinsic value. and it's going to have a delta that's going to approach 1. It's going to move 1 to 1 with the value of that stock. If the stock goes to 101, the call should gain by about $1. And if the stock goes down by $1, it should lose about $1. At the money options, okay, so the call and the put right around the 100th strike with the stock trading 100 will have deltas right around 50. In other words, they will move about 50% as much as the underlying. So if the stock is up $1, the call should increase, all things being equal, by about 50 cents. And if the stock goes down by $1, the puts will increase by about 50 cents. And so, call and put deltas will work in opposite directions. So call deltas are positive, while put deltas are negative. So those at the money options, if the stock goes up by $1, the calls will increase by 50 cents, all things being equal. And if the stock goes down, and then the puts will decrease by about 50 cents. And the stock goes down, the put should increase by about 50 cents. And the calls will decrease by about 50 cents. Now, far out of the money options have very low deltas approaching 0. So if we are looking at a 200 strike call with the stock trading 100, and let's say that stock goes to 101. Well, if that stock goes to 101, then, that option theoretically really isn't going to change that much, okay? It's still going to be $99 out of the money. Stock could go to 102, and it's probably not going to change that much. So that option needs a big movement in the underlying for it to start taking on some value. Okay, so let's take a look at some delta characteristics. So calls have positive deltas or long deltas, while puts are just the opposite. They have negative or short deltas. So I have to make a big distinction here. So there's a difference between being long the contract or short the contract and being long or short the market. So when we speak about options, when if we buy options, whether they're calls or puts, and we're an opening buyer, we would say we're long the contract. Now, if we sold to open the contract, we would say we are short the contract. Now, that's different than being long or short the market. So, generally speaking, when people say they're long the market, they generally mean that they want the stocks, their portfolios to go up. So, if you're long the market, you're probably long stocks, you're long bonds, commodities, Bitcoin, whatever. You want the market to go higher, okay? A hedge fund, on the other hand, is short the market. They might be betting against stocks, so they want to profit if the stocks go lower. So that's directional. So it's very different from being long or short the contract itself. So when we speak about options, when we're saying we're long options, that just means we are long the contract, not directionally. Now the delta will give you direction. So let's just look at the calls. If we are long calls and the stock goes up, the call price should go up because we're long deltas. Okay? The delta is giving us an indication that we want that option to go higher. Likewise, if we are short the option, we have sold those long deltas to somebody else. So we are actually going to be short deltas. So if the stock goes down, the call price goes down. So there's that direct correlation. Call deltas will range from 0 to +1, okay? Puts are just the opposite. So if you're long puts, you want the stock to go down rather than up, because as the stock goes down, your put price will increase by the amount of your delta, okay? Now, if the stock price goes up, the price of your put will theoretically go down, okay? So once again, calls have long deltas and positive deltas, puts have negative or short deltas. Now, another way to look at delta is some traders will look at delta as the probability that that option will finish in the money. So if we're looking at, say, a 70 delta call, that could indicate that there's a 70% chance that the option will finish in the money. And subsequently, if it has a 70% chance of finishing in the money, it would have a 30% chance of finishing out of the money. Now let's look if we sold a 30 delta call. If we sold a 30 delta call, that could indicate there's a 70% chance of that option finishing out of the money or worthless, and about a 30% chance of it finishing in the money. Now, a very important distinction, don't start confusing in the money probability with profitability, okay? Just because an option has a 70% chance of finishing in the money, does that mean that it's going to be a 70%, there's a 70% chance of it being profitable? So let's just say you bought a 95 call and you paid $6 for it. And at expiration, that stock is trading 100. Well, at expiration, that option has an intrinsic value of $5, but you paid $6 for the option. So you lost $1 on the option, but it's still in the money. It's still in the money by $5. So just keep that in mind, that in the money or out of the money does not equal profitability, okay? All right, let's do a quick knowledge check on delta. So here we have shares that are trading right around 100, 45 days to go to expiration. So if an investor buys the 110 calls for $1, what do you think is the expected option value if shares increase to 105? Now, just jot down on a separate piece of paper your answers, because if we get answers in the Q&A box, it will just flood the Q&A box, and we'd like to keep that clean just for regular questions. But just write your answers down on a separate piece of paper. So what do you think? If the shares go up by $5, what do you think the new options value is going to be, all things being equal? Well, the 110 calls have a 20 delta. And remember, the delta is the options change in a 1-point move, for a 1-point move in the underlying. Well, in this case, stock went from 100 to 105, right? Well, that's 5 points. So 5 times 20 cents is $1. You take the $1, add it to the $1 we paid. In theory, that option should be worth about $2, all other factors being constant. Now, is this 100% going to be $2? Well, if that stock went from 100 to 105 very quickly, that option might be worth more than $2. But if it went from 100 to 105 over a 10-day period, it actually might be worth less than $2. So once again, that delta is just a theoretical approximation. It's not going to be 100% accurate all the time, but it gives you an idea of how that option should change if the stock moves, in this case, $5. All right, number 2, if an investor sells 2 out-of-the-money 90-strike puts, what is the estimated probability that the contracts will finish out of the money? You look at the 90-strike puts, they have a 15 delta. What would you guess is what would you think is the probability that that option would finish out of the money? Let you think about it for a few seconds. Well, if the option has a 15 delta, it has a 15% chance of being in the money. It would have an 85% chance of finishing out of money. And if we're short it, that's what we want. We want that option to finish out of the money. So it has an 85% chance of finishing out of the money. And you might notice that the call deltas and the put deltas, if you look at them, they add up to 100. And this gets to a concept called put-call parity. We're not going to get into put-call parity today, but there is a relationship between calls and puts that share the same strike and the same expiration. So those deltas must add up to 100, roughly 100, for this relationship to hold. So if you know the delta of, say, a call, let's say you're looking at a call and it's got a 65 delta, you can infer that the 65 put in the same month has a 35 delta. Or if you know the 35 delta, let's just say you're looking at a 20 level put, it's got a 10 delta. You can infer that the corresponding call has a 90 delta. Okay, so that way you can kind of gives you an idea of estimating deltas. If you know one of the options, call or put, you can infer the other's delta as well. All right, So now let's take a look at this. If an investor buys the 100-110 call spread for $3.20, what is the expected value of the spread? The shares increase to 105. So once again, stock's going to go up $5. Now we've bought the 100 calls and sold the 110s against it. Let's just look at it from a one spread standpoint. We bought the 100 calls and sold the 110s. What do you think the expected value of our spread is with the stock up $5? Now you're going to have to do a little more math. When you think about it, this is a debit spread, so we're long the 100s and we're short the 110s. So when we bought the 100 calls, we bought the long deltas with them, so we're long 50 deltas. Now the 110 calls, we sold those as part of our spread. Now we're short 20 deltas, so 50 minus 20, that's 30 deltas. So this spread has a net 30 deltas to it. Stock went up by $5. So 5 times 30 cents is $1.50. So you take that $1.50 and you add it to the $3.20 we paid, get you to $4.70. Now, when you have a lot of different positions, like when I was on a trading floor and I'm trading hundreds of different stocks and I've got long and short positions on various strikes at various maturities, I would like to know what my net delta is for my overall position so I could manage my risk. And obviously I didn't have to do it manually like this. You know, you'll have a computer that does it for you, and most brokerages have trading platforms that do this as well. But this is what's happening. Your position, you want to net out your deltas to know what your exposure is and whether you're net long or short, or what your position looks like at any given time. All right, so now let's take a look at gamma and what gamma is. Gamma is the delta's sensitivity to a change in stock price. So how much my delta value will change with a $1 move in the underlying. So one way I like to think about gamma is the speed of your delta, okay? All other factors being constant in decimal form, so it's the adjustment to delta. So only options have gamma. Now, gamma is going to be the same for calls and puts that share the same strike and the same expiration. And gamma is going to be, for option buyers, this is what option buyers buy. They're buying the gamma. So if the stock price goes up, your delta is going to change by the amount of your gamma. Likewise for calls, if the stock price goes down, your delta will be reduced by the amount of gamma that you have. Now, the gamma for puts is just the opposite. So if the puts go down, if the stock price goes down, your delta will increase by the amount of the gamma. And if the stock price goes up, your delta will go down by the gamma amount. So this is called it's the speed of your delta, or the delta of your delta. Now, gamma, as we get closer to expiration, changes for the near-term at-the-money options. So the options that have the most gamma are going to be the at-the-money strike and the near-term option. So in this chart, we're looking at the 1-month options, the 3-month, 6-month, and 18-month. And as you can see, we're assuming the stock is trading 60, and we're looking at the at-the-money 60 calls and puts. You can see that the 1-month options have more gamma than the 3-month options, or the 6-month options, or the 18-month options. So the gamma, as we get closer and closer to expiration, gets higher and higher for the at-the-money strikes. If we had a chart of the weekly options that expire this Friday, the gamma would be even greater. It would be even more so. So it's the near-term at-the-money strikes that have the most gamma and are most sensitive to price movements, and which makes sense because remember that at expiration, those options are either in the money or they're not in the money, okay? There's only two outcomes. Now, I know you've probably heard terms in the market lately, exploding gamma or gamma whales or gamma explosion. So what happens is when you see a stock make a big move, and just say, let's just use our $100 stock. Let's just say stock's trading 100, but a lot of investors have purchased out of the money calls. Maybe they purchased the 120 calls, $20 out of the money. But then all of a sudden the stock makes a big move towards that strike, okay? Well, the traders who have sold those options are going to be short a lot of gamma once it gets near that strike. In other words, they're going to be short gamma. Their deltas are going to explode, meaning that they need to buy more and more stock as the stock goes higher and higher just to hedge themselves. So there's this constant battle between the long option holders and the short option holders. So option buyers obviously want stock movement. If you're long calls, you want the stock to go up. If you're long puts, you want the stock to go down. If you're an option seller, you don't want movement. You want the stock just to be quiet and just be quiet and sit and make your theta or time decay, which we'll get into next. But there's as option buyers, you want that gamma, you want the movement. Option sellers, that's not a good thing. Let's do another quick knowledge check. So shares are trading right around 50, 10 days to go to expiration. Let's say an investor were to buy the 50 calls and the shares increase $2. What would you expect the new delta to be? The shares go up by $2. So you can see the 50 calls have 51 deltas. So let's just say we bought one of those contracts. Now we're long 51 deltas. So based on the gamma, what do you think the new delta will be with the stock up $2? Well, you simply take the stock move, $2, you multiply it by your gamma, which is 0.12 or 12. That gets you to 24. 24 plus 51, that gets you to 75. So with the stock up $2, all other things being equal, your new delta should be about 75 for this particular option. So as you can see, as the stock goes higher, you're actually getting longer and longer as the stock goes up, which is a good thing if you own calls. That's what you want. All right, so let's look at a different question. If an investor were short the 50 calls, so we're going to look at the same options, but now we're going to be short them. Stock's trading 50. Would a share price increase to 52, just like it did before, of $2, result in an increase or a decrease in gamma? So if share price goes up by $2, would your gamma increase or decrease? So you have to remember, the at-the-money strikes have the most gamma, okay? So if stock moves away from the at-the-money strike, your gamma is actually going to decrease, okay? So as you can see, at 52, the 52 calls have less gamma than the 50 calls, okay? As right now, the 50 calls have 12 gamma. And as you move away, the 48 calls have 9 gamma, the 52 calls have 10. So as you move away from that at-the-money strike, your gamma decreases. Now, if the stock goes up in your short calls, your delta will increase, but your gamma will actually decrease a little bit. All right, so here's a good question. Now we're gonna think like a trader would think. So if a trader was long 10 of the 52 calls, delta neutral, and I'll explain that in a minute, and shares increased from 50 to 51, how many shares would they need to buy or sell in order to remain delta neutral? So this is what I used to do for a living. So I'm trading on a trading floor, and let's say somebody sells me 10 of the 52 calls, okay, and I'm going to purchase these. So I buy 10 of the 52 calls. They have a 29 delta, as you can see. So 10 times 29, that's 290. So I don't have an opinion on the stock. I'm just trading. Somebody sold me the calls because they wanted to short them. I have no opinion on the stock, so I really don't want any market exposure. So as a market maker, I would go out and I would sell 290 shares of stock. So now I'm long 10 of the 52 calls, I'm short 290 shares of stock, and I'm delta neutral. In other words, I have zero delta, okay? I have a position. I want the stock to move because I'm long the contracts either way, up or down, but I'm delta neutral. So now if I'm delta neutral with the stock trading 50 and now it goes to 51, what is my new delta? Okay, so now you'd have to look at the gamma. So the gamma on the 52 calls, well, it's 10. So I'm long 10 of those contracts. So 10 times 10, that's 100. I would actually be long an extra 100 deltas with the stock up $1. So I would sell an additional 100 shares. Now I would be long 10 calls, and I would be short 390 shares, and I'd be delta neutral again. Now, I'm not saying that that's how you should trade, but I'm just giving you a little perspective on how a professional trader would treat this and would trade and keep themselves somewhat neutral given movements in the stock price. All right, now we're going to talk about theta. So once again, we were talking about there's this battle constantly between option buyers and option sellers. So option buyers want movement, option sellers don't want movement, okay? But when you buy an option, remember that option decays in value over time. So your theta will measure your expected time decay in an option's value with the passage of 1 day. So for option buyers, theta is actually working against you. And for option sellers, theta is working for you, okay? So it's expressed in decimal form, and it's a decay per calendar day, not trading day. So this is really important. So options do decay over the weekend, even though we only trade Monday through Friday, barring any holidays. Options do decay on weekends. They decay on holidays, okay? So they decay over calendar days. And you ask yourself, well, if that's the case, why wouldn't I just sell options on a Friday and buy them back on Monday morning? Well, you could try to do that, but by doing so, you open yourself up to any news that could come out over the weekend. If all of a sudden some bad news comes out and stocks gap down in a big way, or some good news comes out and stocks gap up in a big way, you're exposed to that movement. I can tell you personally, when I was trading on the SIBO on a Friday, I would take my theoretical sheets and I'd run my models on Monday's date to factor in that decay. Because as a trader, I don't want to buy a bunch of options on a Friday and watch them, have a lower value on Monday. So I would actually take my days on my sheets and run them ahead to factor in that time decay. So, buying options or selling options on a Friday and buying them on Monday, that's a hard game. And some people have tried it. It doesn't necessarily work all the time. So once again, when you buy options, you have negative theta. Theta is working against you. When you sell options, you have positive theta, and theta is working for you. It's your friend. So here is a theta, taking a look at an option. We have an option here that's trading $3.50. It has a theta of 3 cents. So right now the contract's worth $3.50 or $350 per contract. So what's the expected value tomorrow if the stock opens unchanged, right at let's say it's a $100 stock again? Theoretically, that option is going to lose about 3 cents in value. It's going to be worth about $3.47. So what is our expected value 10 days from now? Well, you would take 10 days, multiply it by 3 cents. That gets you to 30 cents. So 30 from 350, that gets you to 320. So all things being equal, that option should be worth about 320. Now, is that going to be accurate? No, it's not going to be accurate, because what you have to remember is time decay is not linear. Theta decays in a more exponential rate. And if 10 days pass, that theta, especially for near expiration, will actually decay at a greater rate. Okay, so we would actually probably lose that option might be worth less than 320, okay? All other factors being constant. So just know, and this next chart is going to visually let you see this, but the line at the top here is the at-the-money options. As you can see, as we get closer and closer to expiration towards the right around the 40-day mark, that option starts to decay a lot more rapidly. See, the slope of that line gets steeper and steeper. So options that are further dated all the way to the left, maybe a 2-year leap, while there is data on those options, they're really not going to decay that fast. But once you get to about 40 days, those options decay a lot quicker. So people who like to sell options usually target options that are about 30 to 40 days out because you get that more rapid decay. Now, does that guarantee you're going to make money? No, because the stocks can still move. But people who like to sell options like to target those options because they have the more rapid decay. Now, the in-the-money options, those options decay in a more linear fashion. And that is because they are comprised of mostly intrinsic value rather than extrinsic value or time premium. So those options don't decay as much. Remember, the time to value or the theta is going to be greater for the at-the-money contract because those options are going to be comprised of all time premium, okay? Where the in-the-money options have mostly intrinsic value and very little time premium. All right, so now let's do a theta knowledge check. If shares are trading right around 100, and we buy the 95-90 put spread for 50 cents, what do you think? Do you think theta helps or hurts this position? Well, you have to ask yourself, we bought the spread, so we paid, this is a debit spread, it's an out-of-the-money debit spread. We bought the 95 puts, sold the 90 puts, okay? So we bought the more premium-heavy 95 puts and sold the 95 puts and sold the 90 puts below. So we paid 50 cents. So even though we're contract neutral, we bought one contract, sold another, we actually paid 50 cents. So theta actually hurts us. So the 95 puts have more time premium than the 90 puts. All right, let's take a look at another one. Between the long 80 strike calls, which are trading for 20 1/4, or the 85 strike puts, which are trading for 40 cents, which option do you think is more affected by time decay? Once again, you're going to have to do a little math to figure this out. But remember that time decay only affects extrinsic value. So the 80 calls, stock trading 100, it has more premium in it. We have to look at how much time premium is in those calls. So if those calls are trading 20 1/4, $20 of those calls are intrinsic value, and 25 cents of those calls are extrinsic value or time premium. So actually, in this example, the 85 puts, which are all time premium, have more premium in them and will decay at a more rapid rate, or actually time decay will affect the 85 puts more so than the 80 calls. Even though the 80 calls have more total premium, the time premium for the 85 strike puts is greater. All right, so there you go, the 85 strike puts. So now let's look at this one. This is stock is trading 50, and let's say you are long the April 50, March 50 calendar spread. Now, for those of you who don't know what a calendar spread is, it's when you buy one option. A long calendar spread is when you buy one option further out and you sell a near-term option against it, the same strike. So your forecast for this position, you think in the near term, the stock is going to be very quiet, but then afterwards in April, once March rolls off, you want the stock to make a big move up. Okay, so if this was a call calendar spread, we would want the stock to finish right around 50 for the March expiration, so those Marches expire worthless, and then we are long the April. So if we are long a calendar spread, long the April, short the Marches, what do you think? Do you think theta helps or hurts us? So we're contract neutral again. We're long one contract, short another. So the thing you have to keep in mind, even though we're long the April contract, we're going to pay a debit for this spread. So we're paying money out. But remember, theta affects the near-term at-the-money options. The theta will be greater for the near-term at-the-money. So actually the Marches will decay at a greater rate than the April. So theta, in this case, actually helps us. All right, so now let's take a look at implied volatility in Vega. So what is Vega? Vega is an options value sensitivity to changes in implied volatility. So with every 1% point change in implied volatility, how much will my option position change? Now, I always tell people this. The one thing, if you're going to trade options and you want to trade options profitably, you need to have a good understanding of implied volatility and how it can affect your position. If you can't understand why an option is losing money or your options position is losing money or making money, invariably the answer lies with the change in implied volatility. And implied volatility oftentimes changes in greater amounts than 1%. Sometimes it can go up and down by 5%, 10%, 20%, 50% for some of these crazy stocks that we've been witnessing lately where the implied volatility is through the roof. So when you hear the guys on TV, the pundits on TV talking about implied volatility, all they're really talking about is the level of options prices. Okay, so when implied volatility is high, you can think of option prices being high or expensive. When implied volatility is low, you can think of options prices being lower. So calls and puts both have positive Vega amounts. So if we own the contract, we would be long Vega or implied volatility. So if we're long a contract and implied volatility goes up, that's actually going to benefit us. If we're short the contract and implied volatility goes down, that would benefit us. So once again, the option value, as implied volatility goes up, the option value goes up, and when implied volatility goes down, the options value goes down. Now, implied volatility will affect options differently whether you're looking at the near-term or farther dated options. So obviously options that are more premium heavy, that have more time premium in them, are going to be affected by to a greater degree by changes in implied volatility than near-term options. And arguably, implied volatility is the Greek that has the greatest effect on an options price for that very reason that implied volatility can change in such huge percentage terms. So there's two types of volatility. There's historical volatility and implied volatility. And I actually could speak for hours just on this one subject. And my colleague Ed Modla will actually be presenting in April, actually on April 14th, on volatility concepts. So I certainly hope you'll watch that presentation because it'll be very informative. But this is a really important concept that you need to understand when you're trading options. So historical volatility. Think of historical volatility as how volatile a stock has been in the past, okay? So it's backward looking. So it's measuring how volatile a stock has been, at some point in the past. Implied volatility is forward looking, and it's gauging the market sentiment on how volatile that stock will be between now and expiration. So only options have implied volatility. And implied volatility is constantly changing. It's always moving. And it's moving with, as supply and demand for options moves, so will implied volatility. So let's look at some distributions. So now we've got three stocks, stock A, stock B, stock C. Each one has different historical volatility. So stock A's got a 15% historical volatility, stock B's got a 25% historical volatility, and stock C's got a 35% historical volatility. So which option would you think has the higher priced options, or which stock do you think would have higher priced options? Well, naturally, it would probably be stock C, because it's got a greater range. It's certainly more, it's demonstrated that it's more volatile in the past, over the past period that we're looking at here, than stock B or A. But what do these future distributions, or these past distributions, tell us about the future volatility of each stock? It tells us nothing, really. Remember, historical volatility is backward looking. It's just, you're looking back into the past. Maybe stock C just reported earnings, and stock A, even though it's got a historical 15% volatility, is about to report earnings, and maybe this is a particularly volatile quarter for them. The implied volatility might be a lot higher for stock A, even though its historical vol has been lower in the past. So that's something to keep in mind, that the difference between historical volatility, backward looking, and implied volatility, forward looking. So once again, this gets back to that concept that implied volatility, you can think of implied volatility as an options price. It's what justifies an options price. And I strongly suggest that you try and get a hold of an options calculator to play around with this. We actually have a free one on our website that you can use and model certain options and play around with the implied volatility. Change the implied volatility, see how much it affects the options price when you make the implied volatility higher or lower, and see how much it moves the options price. So, one of the popular questions we get at OIC is, well, who makes these options prices? When I'm looking at an options chain, I see these bid and ask prices. Who's making these? And it's not random. It's everybody in the market. It's market makers who are making a two-sided market. It could be hedge funds. It could be pension funds. It could be banks. It's you and me. It's individual investors who are bidding and offering options. So it's the collective market. So that bid ask at any given time is a snapshot to what the market is expecting going forward. And it's always changing as supply and demand changes for those options. So once again, as implied volatility increases, both call and put prices will increase. And as implied volatility decreases, call and put prices will decrease. And once again, implied volatility will have a greater effect on the farther term options than the near term options. So let's take a look at a volatility example. So we have a stock that's trading right around 100, and we've got 13 days to go to expiration, and the volatility is 50. So as earnings are coming up, maybe the volatility in this case is a little high, and the value of these calls, they're trading $1.85, and we're bullish on the stock, and we think the stock is going to go up, so we decide to buy these calls. Well, a week later, stock reports earnings. So we get our direction right, stock goes up by $5, but look at the value of the option. The option is worth $1.20. It's lost 65 cents in value. So you think, well, what happened? I bought these calls. I got the direction right. Well, yes, the stock went up by 5%, but you needed a greater than 5% move to make money on this option. So keep in mind, volatility went from 50 down to 30, so volatility got crushed. Not only that, but the theta for that full week, when you bought the options, they had 13 days to go to expiration. At earnings day, they've got 6 days to go, so there was a week of theta there. So when you add up all the factors, this stock, these calls are actually worth less with the stock up, and this happens to investors all the time. So this is why it's crucial that you understand when you're buying or selling, a specific strike, that you understand the volatility levels, so then you can determine whether that option is historically expensive or historically cheap. So, in this case, if the stock went to 110, then these options would be in the money by $3.15, and it would, it would actually be a good trade. But just keep in mind that you would, in this case, a 5% move for earnings did not equate into a profitable position for these calls. All right, so now let's do a Vega knowledge check. So now we have the 100 strike call. Is the Vega greater on a contract expiring in 5 days, 30 days, or 90 days? Well, we just discussed this, so obviously Vega is going to be a greater impact on the further dated options. So in this case, the 90-day options, okay? If we had options like leaps that expired in a year from now, those would actually be more sensitive to changes in implied volatility than the 5-day, 30-day, or 90-day options. Let's say an investor puts on a covered call strategy, which is one of the more popular strategies that many investors do. I know many of you have probably put on the strategy. Do you have a long or short Vega position by doing this position? And will an increase in Vega help or hurt your trade? So if we're putting on a covered call, we're going to be long the stock, and we're going to be short maybe an at-the-money or an out-of-the-money contract. So what do you think? Are we long or short Vega? Well, if we're short options, we're going to be actually short delta. We're going to be short a little gamma. And in this case, we're going to be short a little Vega. So actually an increase in Vega will hurt the position in the near term. So we're short Vega, and an increase in volatility will actually work against us. All right, last question. If a stock drops 15% out of the blue as a result of some unexpected company news, maybe the CFO stepped down, or they're pre-releasing earnings, or maybe they didn't get a government contract, something happens. Will long or short Vega positions likely to be more positively impacted? So which position would be more positively impacted, a long Vega position or a short Vega position? Well, if the stock drops out of the blue, okay, there's probably going to be nervousness within the stock. When stocks go down, typically implied volatility or options prices go up. And when the stocks go up, option prices or implied volatility tends to go down. So in this case, unexpected news, big stock drop, more than likely long Vega positions will be impacted positively because they will increase in value with a rise in implied volatility. All right, so the last Greek we're going to look at is interest rates, or Rho. Now, Rho is essentially measuring an option's sensitivity to changes in interest rates. Okay, so how much my option value will change with a 1 percentage point change in the risk-free rate. Now, when I say the risk-free rate meaning the interest rate between today and your expiration. Okay, that would be the risk-free rate. It's expressed in decimal form, and it represents a cash amount per option, all other factors being constant. Now, this Greek is considered the least significant of all the pricing factors. And why is that? Well, unlike implied volatility, which can change in 5%, 10%, 20%, big percentage point change moves, interest rates really don't change that much. Oftentimes if they change in quarter percentage points, 25 bips, 50 bips, very rarely do they change 1%. So, and once again, interest rates are somewhat predictable, or at least you can kind of anticipate them to a degree looking at a treasury yield curve. So to a degree, that gets factored into an options model. So interest rates are used in pricing models to take into consideration an options price based on its hedged value as well. So, if I buy calls and I'm a market maker, I would probably sell stock against it to hedge. That cost to carry that I'm going to get from being short stock is going to factor into my options price. Likewise, if I bought puts and I have to buy stock, I would have to factor in the interest rate on that stock into my options position. So Rho will actually affect the more in the money options, as well as the deeper in the money options, as well as the further out options, the ones that carry more time value and such as leaps and whatnot. So the interest component, it's a smaller portion of any option's total premium, but it is still there. Now, one way to look at this, and this is actually the easiest way to think about it. So Rho is always going to be positive for calls, and it's going to be negative for puts. And why is that? Well, think of it this way. What if I had $100 and rates are right around 1%? And that implies that a year from now, that $100 should be worth about 101. So if rates go from 1% to 2%, the future value of my $100 is now worth 102. So as you can see, as the rates increase, the future value of my money is increasing. So call prices would actually have to, because they're being priced off the future value of a security. If rates increase, that's implying that the future value of stocks would increase, which would mean that call prices would have to increase. And now if call prices are increasing, likewise, put values would have to decrease. And for the same reason that when rates go up, this is directly correlated to calls. If rates go down, call prices will actually decrease, and put prices will actually increase. Now, when I was on a trading floor and I had my sheets and I had all my Greeks, to be perfectly honest with you, I would never look at my Rho. I had a Rho number there because I was facilitating option flow, and I had Rho exposure. It's nothing that I could control, but I had to be aware of it. But it's nothing that I can control. So out of all the Greeks, it's the one that I was least concerned with. So now I know that was a lot of information today. Certainly you can view this webinar again. You can actually use the same link to access this webinar and rewatch it at your convenience whenever you want. For more information regarding anything to do with options, you can certainly reach out to us at options@theocc.com with any and all of your options-related questions. And please check out our website, optionseducation.org, where you'll find other educational materials, all free of charge. You can also check out our OIC YouTube channel, where we actually archive many of our past webinars. This webinar itself will actually be archived on that channel at some point, as well as our OIC website as well. And also, please like us on Facebook as well as Twitter. So with that, I want to thank everyone once again for attending. I know that was a lot of information. Believe me, this will sink in. It's not as complicated as some investors think they are. So sometimes you just might have to, think about it and maybe rewatch the webinar. But once again, I thank you for attending. Good night and good luck trading. And we look forward to seeing you at the next event. Bye-bye, everyone.